Give us your sense of the economy and where it is. Talk about, first of all, just what we're talking about right now, wages. Are you seeing a lot of pressure on your margins because of wage increases?
No, I mean, we've had standard merit increases for our employees for all the 20 years that I've been with United Rentals, and we continued on that same track currently. So we're not seeing wages increases, and we think that this is more of the same from 2018. Very similar margins, very similar opportunities for growth, very similar demand environment.
Are you finding any difficulty in getting the people you need with the training that you need them to have?
No, we have a very, very strong focus on people. It's part of our culture. So we have industry-leading turnover, retention. We're less than 10% voluntary turnover. So we may be swimming upstream on this for some other companies, but we don't have that labor issue. But there's been a large commitment to that from our organization to overcome any of the challenges that a very low unemployment may cause.
The nature of your business keeps your finger on the pulse of a lot of the economy, particularly in the area of, for example, construction. You rent a lot of equipment, as I understand, construction. What are you seeing across the country in terms of the demand for construction?
So we're seeing very broad demand. So as you may know, we operate in 49 of 50 states, and I actually have a long line of people waiting to open a store in Hawaii and work there for us. And we're in all 10 provinces of Canada. So we have 1,200 locations with managers and sales folks with their ear to the ground, and our growth is very broad. We had over 20% growth in 18. If you look at the midpoint of our guidance, we're projecting almost 16% growth in 19. And we have that additional opportunity with those 1,200 locations, with having ears to the ground, and our customers have good backlogs.
So that pace of growth is extraordinary, and you've kept it going for some time now. 20% growth is unbelievable. How much of that is taking market share from somebody else, and how much is just the overall pie growing?
So our industry's been going through a consolidation effort, and so we had quite a few acquisitions. So in 18, we had about 21% growth full year, but it's not all M&A. 11% of that was pro forma growth. So it's still significant and robust growth, even on a pro forma basis, and growing off the new footprint that we've created.
All right, you get a lot of capital, get some free cash flow. List your priorities. What do you want to do with it? How do you deploy it?
First and foremost, always investing in the business. So organic growth would be the first priority, the first filter we'd look through. Then we're a very acquisitive company, so we have historically used M&A, but I would say that bar is raised for us because we've acquired we acquired 3 of the top 10 companies in our space in the last 18 months. So we have a lot to absorb and leverage. So I would say more towards organic right now. And then it's a combination of returning money to shareholders, whether it's through lowering debt, share buybacks, which we've done both. We feel very good. We're fortunate that we are free cash flow positive throughout the cycle now.
When you talk to investors, are they happy with that order of business? What I'm trying to get at is there's a big debate in the investing community on what should companies do with their cash. Are we going to reward companies that spend on buybacks? Are we going to reward companies that spend on CapEx? And what are the conditions with which we like the CapEx spend?
So we do listen to our investors, our shareholders frequently, and we also review this capital deployment strategy with our board on an annual basis. But I think the important thing is not to look at any of them in isolation. What's your leverage? What's your growth? What's your buyback? So I don't think it's looking at any of them individually, but the combination of what are you doing with the shareholders' money and how are you investing it.
To what extent is your business improved because people are saying, I want to outsource it? I don't want to own the equipment myself. I'd rather have somebody else own it, and I'll rent it from them.
So it's a great point. We're one of the original sharing economies. The rental business in itself is taking all the aggregate demand that individual contractors, plants, job sites will have, and sharing that demand to the point where when we look at this, our assets have 4 times higher utilization than our customers' assets that they own. And we track this, and this is part of the selling point for the industry, which we lead. So we think there's a great opportunity there, and that's really what the rental business is all about.
In that world, do your suppliers have pricing power? That is to say, are you seeing list prices for that equipment go up?
So we're lucky that we have, fortunate to be the largest customer for almost all of our top 10, I think every one of our top 10 suppliers. And we have good partnerships that we've had. So we're not seeing any additional inflation over the normal 1.5% inflation that we've been pegging for the last 5 years.
What area of the market/economy do you have the least visibility on right now, and why?
So I wouldn't, there's no area that I'd say we have the least visibility. What we focus on, about 50% of our revenue is industrial. And every industrial vertical that we tracked in 18 and forecasted for 19 have been positive for us. And then we're about 50% non-res. So there's some numbers, the residential, and even that is more single-family homes. We don't play much in residential, but where we do, it's multifamily, which is actually doing pretty well still.
Okay, are you projecting out the same level of increase in revenues and earnings that you have in the past, and where's it going to come from?
So our growth opportunities are going to come in the sectors that we serve, and whether it's, as I said, in the industrial sectors or whether it's in the non-res construction, we have very deep relationships, very deep penetrations. As I mentioned earlier, the growth's been broad, so there's no hot pocket that we relied on for that 11% pro forma growth. So where the growth comes from is deepening the relationships, solving more problems for our customers, whether they're on job sites and plants, and aggregating that demand. That's the rental model. We're very bullish on 19. We have a customer confidence index that we track that for the past 12 quarters has remained strong at a very high level.